Welcome to the deep dive. Ever look at a company's financial statements and just, wonder how they even justify presenting themselves as an ongoing business?
Yeah.
Well, you've hit on a really core concept, the going concern assumption. It sounds technical, maybe a bit dry, but honestly, it's probably the earliest financial warning system we actually have. Our mission today is to, cut through the jargon. We want to explain how the auditor, that independent check, navigates this whole area. Specifically, what are their responsibilities when it comes to that going concern assumption used in preparing the financials you read?
Right. And look, this isn't just some loose suggestion box. It's a very structured standard. So to help you really grasp it without getting overwhelmed, we've broken the auditor's role down. It's basically a four-stage framework straight from the standards themselves. First, we'll define the responsibilities. Who actually owns the assumption? Who checks it? Second, we'll get into planning. This is like the auditor's initial scan for potential problems, for vulnerabilities. Third is audit evidence. This is the real investigation, the digging into whether the company can actually keep going. And finally, conclusions and reporting. This is how you, the public, and the board find out what the auditor actually found.
Okay, let's unpack that structure then.
Yeah.
Starting with responsibilities, setting the stage. When we talk about a business continuing, what exactly is this going concern assumption asking us to just accept?
It's really the baseline idea. The going concern assumption, fundamentally, assumes the company will keep operating for the foreseeable future. We usually think of that as, say, the next 12 months. It assumes they won't be forced to liquidate or, drastically shrink, because if you can't assume that, well, the whole valuation changes, doesn't it? Assets aren't worth their cost anymore. They're worth what you can get in a fire sale.
A liquidation value.
Exactly. It flips the whole financial picture. Think thriving business versus salvage job. That's the difference.
Wow. Okay. That really raises the stakes. But who's making that call initially? Who gets to say, yep, we're good to go, we'll survive?
That responsibility, it falls squarely on management. Management has to assess if the going concern assumption is appropriate. They look forward from the balance sheet date. They're the ones with the operational data, the sales forecast, the inside track on restructuring plans. They own that assessment.
But doesn't that create a bit of an inherent conflict? Management always wants to look good, right?
Of course.
They don't want to signal weakness to the market or scare their employees. So if they're making the call, what stops them from just, painting a rosy picture?
And that's precisely where the auditor comes in. It clarifies the auditor's responsibility. Look, the auditor isn't there to guarantee the company survives. They don't have a crystal ball. Their job is specifically to get enough appropriate audit evidence about the reasonableness of management's use of that assumption.
Ah, okay. So they check the homework, they look at the assumptions management made, the calculations behind the optimism.
Exactly. Checking the homework is a good way to put it.
That's a really critical difference. The auditor isn't promising the ship won't sink.
No.
They're just checking that management isn't making up the coordinates on the map.
Precisely. They audit the process, the data, not the future outcome. And if they don't find evidence supporting management's claim, or if the evidence points to significant doubt, then they have to raise the alarm.
Which leads us neatly into stage 2, planning. Okay, the auditor knows their role, be skeptical, gather evidence. How do they even begin that search? This is where they start looking for those cracks in the foundation.
Yeah, the planning stage is all about being proactively skeptical. It kicks off with risk assessment. The auditor has to systematically look for events, for conditions, anything that might cast significant doubt on the company's ability to continue as a going concern. They're scanning everything: economic trends, operational issues, financial red flags. And this often involves spotting specific indicators of significant doubt. Like, are suppliers suddenly demanding cash only? Are there major lawsuits looming? Are key people leaving? Things like that. Sure, falling sales are a worry, but things like chronic negative cash flow from operations or breaking loan agreements, those are the real sirens.
Okay, so the auditor spots a big red flag. Let's say a huge loan is due in 6 months, and the company clearly doesn't have the cash right now to repay it. Does that immediately mean, going concern problem?
Not necessarily straight away, because the standard requires balance here. If those indicators of doubt pop up, the auditor then has to evaluate management's plans to deal with them, the mitigating factors. Does management actually have a concrete, workable plan to handle that debt? And here's a key thing. The auditor isn't just checking if there's a plan. They're assessing how persuasive the evidence for that plan actually is.
Right. And what makes a plan persuasive versus just wishful thinking?
Well, It often comes down to control and certainty. A really persuasive factor is something the company largely controls. For instance, maybe they're selling a specific non-essential factory and they already have a binding contract that closes next month. That's solid. What's less persuasive and riskier is a plan that relies heavily on things outside their control, like hoping the whole economy suddenly booms or banking on finding a massive new investor who hasn't even been identified yet.
Oh,
The more it depends on external factors or things just falling into place, the less comfort the auditor gets from it.
got it. So the auditor has to really stress test that optimism. If the plan needs a miracle, it's probably not good enough evidence. Okay, now we're moving from sort of like identifying risks to the real core. Audit evidence, the investigation itself. What do they actually do to get that hard evidence?
Well, this phase is about gathering comprehensive proof. It means consulting a whole range of sources of information. We're talking way beyond just the main financial numbers. Auditors look at detailed internal budgets, minutes from board meetings discussing strategy, letters exchanged with banks, legal opinions on lawsuits, all sorts of things. And crucially, they have to perform specific procedures aimed squarely at that going concern assumption. It's not just a general once-over. For example, they might recalculate the company's loan covenants to check for breaches, review the exact terms of major debts, or analyze if the assets management plans to sell are actually sellable at the needed price.
And we absolutely have to talk about cash flow here, because that's often the tipping point, isn't it?
Oh, absolutely.
A company might look profitable on paper, but if the cash runs out, well, it's game over pretty fast.
Exactly. That's why there's such a critical focus on cash flows. Cash flow information is just paramount for assessing short-term survival. And the auditor doesn't just take management's forecast at face value, they dissect it. They'll often perform sensitivity analysis, what we sometimes call stress testing the forecast. They ask tough questions.
Like what?
Like, okay, what if sales drop 15% instead of the 5% you projected? Or what if this major customer goes bust? They test the underlying assumptions, especially around liquidity. Can the company actually meet its bills as they come due over the next year?
That's fascinating. They're actively trying to break management's model to see how robust it is.
In a way, yes, to test its resilience.
Now, what about things that happen after the financial year ends, but before the audit report is actually signed off and issued?
Ugh. Subsequent events, hugely important. The auditor must consider events that happen between the balance sheet date and the date they sign their report. A major subsequent event, maybe they successfully refinance a big loan after year-end, or maybe they get hit with an unexpected massive regulatory fine that can totally change the going concern picture that existed based just on the year-end numbers.
I remember reading about a case, I think it was a retailer, where the auditor had serious concerns. But then, literally weeks before the report was due, a huge last-minute investor put in a load of cash. That subsequent event basically saved the going concern basis for them.
Exactly. It shows why the standard insists on looking at the latest possible information. And this connects to something people often miss. The standard allows the auditor to look beyond the assessment period that management typically uses.
What do you mean?
Well, management is usually required to assess for 12 months from the balance sheet date. That's the standard requirement for them. But the auditor standard gives the auditor flexibility to look further out if needed. Why? Let's say the company has a known massive debt payment due in month 13, right after management's 12-month window closes. If the auditor only looks at months 1 to 12, they miss that obvious cliff edge, S.
Right.
So if there are serious doubts already, the auditor needs to consider information about viability immediately after that 12-month period too. That responsibility to look further when it's warranted makes the audit review much more robust than just ticking a box on management's required period.
Wow. That's a big responsibility, giving the auditor the power to essentially override management's timeline if needed. Okay, so we're at the finish line now. Conclusions and reporting. The auditor has all the evidence. They've stress-tested the cash flows, read the board minutes. What happens next? What's the final word?
Well, the basic principle is pretty straightforward. Is the going concern assumption appropriate or is it inappropriate? If it's deemed appropriate and there are no major uncertainties, things proceed normally, more or less. But if it's not appropriate, or if there's still significant uncertainty hanging over it, then specific reporting duties kick in, and these are mandatory.
Okay, let's clarify some terms here, because people hear scary phrases like material uncertainty or adverse opinion. Practically speaking, what's the difference for, say, an investor reading the report?
Okay, yeah, this is a critical distinction for you, the listener. If the auditor concludes a material uncertainty related to going concern exists, it means a couple of things. First, management likely identified the serious risk correctly and disclosed it properly in the notes to the financial statements. But second, the risk itself is still very real and significant. The auditor then must highlight that specific note in their own audit report, usually in a separate paragraph.
So material uncertainty is like a big mandated caution sign flashing.
That's a good way to think of it. Yeah. It's saying, look, the company might be okay, but there's this major risk factor, and we, the auditors, are forcing you to pay attention to management's explanation of it right here.
And the adverse opinion, that sounds much worse. Is that the nuclear option?
It absolutely is. If the auditor believes using the going concern basis is flat out inappropriate meaning, they think the company is basically insolvent already or headed for liquidation within that foreseeable period. Then the auditor has to issue an adverse opinion. That means the financial statements themselves are fundamentally misleading because they're based on the wrong premise.
Because the values are wrong.
Exactly. Assets should be at liquidation value. The statements, as presented, are materially misstated. They likely need to be withdrawn or completely restated. That's the loudest possible alarm bell the auditor can ring to the market. Failure signal.
And before any of this hits the public report, there's a crucial internal conversation that has to happen first, right?
Correct. And this might be one of the most important procedural steps. Communication with those charged with governance. The auditor has the often difficult job of sitting down with the highest level of oversight, usually the audit committee or the full board of directors. They have to discuss their findings, their concerns, and ultimately their conclusions about going concern. This makes sure the company's leadership knows exactly where the auditor stands on their viability risk and why the auditor thinks the financials might need changes or extra disclosures. It forces that top-level accountability.
This has been a really fantastic deep dive into something that honestly holds so much of the financial world together. So for you listening, you now have that clear four-part framework for understanding the auditor's role here. It starts with that high-stakes split. Management's assessment versus the auditor's required skepticism. That skepticism then drives the detailed planning, looking for doubt, which leads into the crucial evidence phase, auditors stress testing cash flows, looking at subsequent events. And finally, that duty to report distinguishing clearly between that caution sign of material uncertainty and the fundamental flaw of an adverse opinion. And importantly, making sure the board knows.
And that brings us maybe to a final thought for you to chew on. We've seen how this whole rigorous four-step process is designed to protect investors, really, by forcing this critical look at future viability before disaster strikes. But think about the wider market impact of this transparency. When an auditor does issue that material uncertainty warning in their public report, how does that disclosure change how creditors, suppliers, even customers interact with that company? It's a powerful mechanism, isn't it? Signaling reliability or the lack of it, forcing accountability, and maybe, just maybe, preventing some of those hidden failures from bringing down parts of the wider financial system. Something to consider.